Hello, everyone. Good morning, good afternoon, good evening, wherever you are. It's really our pleasure to introduce you to Cynthia Pastor. She is the Director of Economics from the Global Infrastructure Hub, where she leads the development, delivery, and dissemination of GI Hub's economic research and policy recommendations for the global infrastructure landscape. Prior to joining the GI Hub, she worked as an economist at the Infrastructure and Energy Department of Inter-American Development Bank in Washington, D.C. Previously, she worked at the Instituto Peruano de Economía, a think tank founded by the World Bank in 1994, where she led the formulation of economic research and policy recommendations to advocate for the still pending economic reforms in Peru. So, over to you, Cynthia, to present the GI Hub's the research which you are leading and overall the monitor.
Thank you so much, Jyoti. Yes, good evening to everyone. Good morning, good afternoon. I'm going to present the latest flagship report of the GHUB, that is the Infrastructure Monitor Report. Let me first share my screen so we can start. Okay, so the Infrastructure Monitor 2021. So one of the instruments to close the infrastructure gap is the mobilization of private capital. This has become even more critical as the COVID-19 pandemic has further limited the financing capacity of the governments. In this context, the G20 is committed to a roadmap of infrastructure as an asset class, through which they are aiming to close that infrastructure gap by mobilizing more private capital into infrastructure. Infrastructure Monitor is then our annual flagship report on state of the private investment in infrastructure. It provides in-depth analysis of the current global levels of private investment in infrastructure and also the infrastructure investment performance. This tool provides data insights in order to ensure that the policy discussion around investment in infrastructure is grounded in actual evidence of what is happening. So our report is addressed to a broad global audience, policymakers, private sector, and academia. So what does Infrastructure Monitor include? We have an annual report which basically consolidates all the work that we have been doing throughout the year around 4 priorities: private investment in infrastructure, private infrastructure investment performance, environmental, social, and governance factors in infrastructure, and infrastructure project preparation. The report is just a highlight because the Infrastructure Monitor is a live tool and we add content throughout the year. Every 2 weeks, we publish insights about issues related to the report where we can present a deeper analysis. And every 3 weeks, we publish policy blogs in which we discuss the viewpoint of renowned global experts and what are their policy recommendations. So how are we delivering this tool? So data around infrastructure as an asset class is scarce. Infrastructure Monitor aggregates from a large number of infrastructure databases, some of which are confidential or not publicly available. We did this by partnering with leading global organizations like Moody's, EdHec Infra, MSCI, GRESB. And also we have leveraged data from a number of other providers. And the main one is Infrastructure Journal Global. So what are the key findings of Infrastructure Monitor 2021? First, globally, we see that private investment in infrastructure projects in primary markets has remained resilient to pandemic shocks in 2020, but has been stagnant for 7 years. In fact, if we compare it with the last decade, there has been a slight decline. In the analysis, we are just looking for primary markets because we want to assess the new infrastructure that is created in terms of greenfield. So we exclude secondary market transactions like acquisitions or refinancing, basically already existing infrastructure that is only exchanging hands. This resilience to the pandemic is a positive sign because, as you know, several sectors of the economy were significantly harmed by the pandemic, but the private investment in infrastructure projects was resilient overall in 2020 compared to 2019. About three-quarters of private investment in infrastructure projects happened in high-income countries, and this investment was unhindered by the pandemic. However, the remaining one-fourth happens in middle and low-income countries, and it fell by 28% in 2020. So a bigger question for us is until what extent the private capital can fill the infrastructure gap, especially in these regions, low and middle income countries, which have attracted private capital in a limited way. So the pandemic impact varied by infrastructure subsector. As we have seen during the pandemic, overall private investment in infrastructure projects remain resilient. But if we analyze this by infrastructure sectors, this changes. For example, the decline in the economic activities and the lockdowns and travel restrictions negatively impacted the transport sector and the non-renewable energy sectors. But on the other hand, all of the switch to online platforms and pandemic control activities supported the growth in telecom and social infrastructure sectors. So, renewable energy projects dominate private investment in infrastructure. Despite they have fallen a little bit in 2020, renewables continue to attract the most private investment in infrastructure projects, accounting for almost 50% of private investment, mostly in Western Europe and North America, and in wind and solar projects. But there is still a long road ahead. While 54% of the private investment in infrastructure projects in high income countries happens in renewables, most of the private investment in infrastructure in middle and low income countries takes place in the transport or in the non renewable energy sectors. But we are seeing an increase in time in the renewable energy against the non renewable energy investment in these regions. So hopefully this trend will reverse. So as I am mentioning, green investment currently represents half of the private investment in infrastructure projects, but green investment outside renewables remains really low. This graph is showing that in the last decade, green investment in infrastructure projects has significantly grown, and currently, as I mentioned, represent half of the private investment in infrastructure projects, mostly in renewables in high-income countries. But green private investment in infrastructure still needs to keep growing and increase significantly to reach net zero targets. And the efforts to decarbonize infrastructure must also look beyond renewable sector into other sectors, for example, transport, where green private investment remains low. So showing attractive financial performance is a key element for bringing private investment into infrastructure, especially into sustainable infrastructure. Unfortunately, sustainable infrastructure investment is constrained by the limited data on how ESG factors are impacting the financial performance. And currently, we have found some preliminary evidence that shows superior performance for some sustainable infrastructure investments in comparison with other infrastructure sector investments. This graph currently showing that in the last 10 years, unlisted wind and solar equities, which account almost like for 90% of the energy investment, have generated higher annual returns than listed and unlisted infrastructure equities. Now, who is financing private investment in infrastructure projects? Well, it is mostly financed by financial service institutions, primarily commercial and investment banks. But in some regions, we have seen an active role of other financiers like developers, multilateral banks, or export credit agencies. Despite that private financiers have increased their role over time, 75% of the private investment in infrastructure in middle and low income countries still needs co financing from non private actors. such as development banks, export credit agencies, or the public sector. That co-financing is more required, as I am mentioning, in developing countries to finance more investment. Whereas in high-income countries, we have seen that over 50% of the private investment financing is flowing through the private sector alone. So, as I already mentioned, in order to attract private investment into infrastructure and establish infrastructure as an asset class, the financial performance of these investments is critical. Private investment in infrastructure, with the evidence that I am going to show, shows that infrastructure projects have been resilient to pandemic, remain stagnant over time, but show a strong financial performance. Our data on equity performance specifically shows that infrastructure as an asset class is providing attractive and resilient returns to investors. In this graph, particularly, we show that in the last decade, returns for the listed and unlisted infrastructure equities have strongly increased. The pandemic temporarily stopped this trend, but they quickly recovered or resumed in 2021. In particular, unlisted infrastructure equities. They have provided higher risk adjusted returns over the entire decade, higher than both global equities and listed infrastructure equities. Our data on debt performance also show us that infrastructure as an asset class provides attractive and resilient returns for investors. In this graph, we can see that infrastructure debt consistently performs better than non-infrastructure debt, and even more so in high-income countries. You can see that debt in high-income countries has lower default rates than the low-income countries, but in both cases, infrastructure debt remains less risky than non-infrastructure debt. So this performance actually continues to improve over time as new infrastructure debt reaches investment grade faster than older infrastructure debt because of many reasons, maybe better project preparation, improvement in the financial conditions, or others. So evidence is showing us that infrastructure as an asset class provides attractive investment options for investors to diversify and optimize their portfolios. In this graph, we are comparing the risk against the return of infrastructure investments over a decade. We see that infrastructure debt provides a significant higher return than 10-year treasury bonds of developed economies at a slightly higher risk. We also see that listed infrastructure equities in emerging markets have a relatively high risk and low return profile. But in developed markets, they provide considerably returns at a lower risk than average global equities. And then we can see also that unlisted infrastructure equities provide returns quite close to global equities at a slightly lower risk. So overall, infrastructure investments are providing good returns and have the potential to attract private capital. But despite the good financial performance that I have shown, we have seen an stagnation in the private investment in infrastructure. So why? Well, one of the major bottlenecks in attracting private capital to infrastructure is the lack of a bankable investment-ready pipeline of infrastructure projects. So creating this pipeline requires the strengthening of infrastructure project preparation capabilities. This graph is showing to the left. It's based in our InfraCompass report and shows the current capacity for the countries to create projects for infrastructure. There is a space. We have seen that there is a space for improving the project preparation capabilities across all regions in the world, in particularly for low-income countries. So our report tries to explore the channeling of funds, mostly to emerging economies, to improve project preparation through the lenses of the project preparation facilities, or PPFs. So governments often lack the resources and the capacity to do project preparation. So the PPFs play an important role in supporting project preparation to develop this pipeline of bankable and investment-ready projects. Since 2000, the year 2000, their creation has grown exponentially. Over 80% of them were created.
Cynthia, I just wanted to say it's only 2 minutes left.
Yeah, I'm done. Over 80% of the existing project preparation facilities were created after 2015, and they are providing technical and funding support for project preparation. They are mostly led by MDBs, and they are mainly providing support in the developing countries or areas like Africa and Asia. So to conclude, I'm going to say that overall, there continues to be a massive potential for private investment in infrastructure, given the large and unmet infrastructure gap, the stagnating level of private investment in infrastructure projects, the ongoing attractive financial performance of infrastructure investments, the promising early trends for sustainable investment, the likelihood of significantly new transactions as the 3.2 trillion of infrastructure stimulus announced by the G20 governments takes shape, and the potential for strengthening project preparation capabilities that will help to create a bankable and investment-ready pipeline of infrastructure projects for investors. I'm going to stop here. Infrastructure Monitor has interesting findings and results, and I invite you all to visit our Infrastructure Monitor webpage and assess them in more detail. So thank you so much, and don't doubt in contact me if you have any questions. Thank you so
Thank
much.
you, Cynthia. There's one question, and just quickly, you have 1 minute, less than 1 minute.
Yeah, let me stop sharing my computer and
You can
go
see it on the screen.
in implementing ESG, and yeah, let me read it.
You have 30 seconds.
What do you mean by three entities to provide thriving green and green infrastructure?
I'm sorry, we are actually out of time. So please feel free to reach out to Cynthia directly on the speaker in the people tab. But we have to actually now end this session because Jamaica is starting. So we need to switch to
Okay,
Jamaica.
I will contact Eloy in the
Yeah.
backstage, and
Okay.
I will answer the question. Thank you so much.
All right. Thank you so much, Cynthia.
Thank you.